We have the pleasure today of providing quite a diverse and impressive group of speakers for you on a topic that I hope you'll find most interesting. It's not one that we've addressed before, but introducing the topic of finance is certainly one that is essential and highly fascinating to many of us undertaking this challenge of industrial decarbonisation. So please just 1 or 2 more minutes that we'll give for people to join the call, and then we shall get started. Okay, that's an excellent time for us to start with the formal part of our welcome and introduction. Welcome everyone, my name is Alan Monaghan. I'm the coordinator of the Net Zero Industries mission. Today we have an exciting webinar to bring to you on the topic of financing the green shift, unlocking climate capital for emerging markets, and we are very proud to be presenting this webinar in collaboration with AFID, the Alliance for Industry Decarbonisation. As your moderator, it is my pleasure to introduce our first speaker for you. I would like to introduce Urban Paker. Urban is the mission director of the Net Zero Industries mission. He represents our co-lead nation of Austria. You may have noticed my accent is Australian, the other co-lead country. Urban is currently the head of the Industry, Enterprise and Financing Department at Austria's Climate and Energy Fund, and brings to the role extensive experience in industrial transformation, clean energy and financing. To introduce our mission, can I please welcome Urban to start his presentation.
Thanks a lot, Alan. Thanks for this kind introduction. So greetings from Austria to Australia at this point. It's my great pleasure to welcome you to today's webinar. It's part of the Industry Insights series, and this is today already the 7th session in the series. And as Alan has said, it's a special one, as we're really delighted to co-host it today with our long-standing partner, the Alliance for Industry Decarbonisation, AFID. AFID is an alliance that has truly created momentum in accelerating the decarbonization of industrial value chains. So we're really glad that we can co-host it together today with AFID. Thank you all for joining us from across the globe. It is a pleasure that is, again, a truly international audience. I'm speaking to you today from Vienna, and whether it's morning, afternoon, or evening, where you are, we are really thrilled to have you with us. Thanks for being here. And as Alan said, I would like to briefly introduce the Net Zero Industries mission to you. So I think we've prepared a slide for that. Maybe we can jump to the next slide. Yes, very good. So we are a global initiative under Mission Innovation, and we are dedicated to accelerating the transition of energy-intensive industries such as cement, steel, and chemicals. And we want to support them in the transition toward net zero carbon emissions. These sectors I've mentioned are vital to many of our economies, and they account for approximately a quarter of global greenhouse gas emissions, and obviously transforming them is essential to achieving our global climate goals. It is challenging as reducing emissions in these industries is particularly complex, and high costs are usually involved in these transformation pathways. Many breakthrough technologies are available, but still need to be scaled up and brought to the market. And our goal is to implement 50 large-scale demonstration projects across all the energy-intensive sectors. And you can see on the next slide, you can see a wrap-up, I think, of our goals. So if you can move to the next slide. Yes, thanks. We support the rapid development of breakthrough low-emission technologies, and we help to advance them to higher technology readiness levels, and that helps as well reducing capital expenditure. And one of the main reasons why we host these webinars is to share knowledge and to promote innovation solutions for the net zero transformation. Knowledge is key to build trust in new technologies, and today we will spotlight a particularly important lever for the transition and one that would be unimaginable without trust. The topic of finance is very much linked to trust, and I'm happy that we will contribute in unlocking climate capital for emerging markets today with our webinar. And over the next 2 hours, we will explore critical intersections between climate finance and sustainable industrial development in emerging markets and developing economies. And we aim today to showcase practical, scalable pathways to access climate finance. We managed to bring together experts from financial institutions, industry leaders, and voices from the Global South. Thank you a lot for taking the time and sharing your insights. We hope that this webinar will bridge knowledge gaps. We will help to exchange insights, and that we will learn in the course of the next 2 hours more about concrete strategies in green transition. And to make this happen, as always, we encourage you to take an active part in today's discussion. Please ask questions, share your perspectives, please engage with fellow attendees. Thank you once again for being with us today. Let's get started. Let's dive in. And with that, I'd like to hand over back to you, Alan. You will guide us through this webinar. Thanks for doing that, and greetings from Vienna at this point.
It's our pleasure. Thank you, Urban. It is now actually my pleasure to hand over to Begonia Guterres. This presentation, as Urban has mentioned, is actually a collaboration between Net Zero Industries Mission and the Alliance for Industry Decarbonisation. And Begonia is going to be introducing AFID to the group. But if I could first, Begonia is an associate professional for the Industry Decarbonisation at the International Renewable Energy Agency, or as we all know it, ARENA, since last year, 2024. She supports the partnerships work done in ARENA, focusing on multi-stakeholder platforms such as the Alliance for Industry Decarbonisation, our partner here today, and the Utilities for Net Zero Alliance called UNENZA. If we could, please, Begonia is now going to briefly introduce AFID to you all. If I can hand over to you, Begonia, please.
Thank you so much, Alan, for those introductory words. And hello, everyone. Good morning, good afternoon. It's my pleasure to be here today. My name is Begonia, and I will introduce you to AFID. Just give me a second. I will share my screen. Okay. Can you see my whole screen? Okay. I hope yes.
Yes,
so yeah,
yes, we can.
Nice. Hi. So yeah, it's my pleasure to introduce you today to the Alliance for Industry Decarbonisation, or AFID, a global multi-stakeholder platform hosted by ARENA and co-chaired by Siemens Energy and M Steel. But before going into more details about AFID, I want to say thank you to the Net Zero Industry Mission to co-organize this very relevant event today for all of us. So with that, I will explain you more in detail what's AFID. So, and also start with why an alliance like AFID is so relevant. So as you might know, the industrial sector produces around 1/4 of global GDP, but it also accounts for up to 40% of global greenhouse gas emission. And the decarbonizing industry sector is no longer optional, but it's also crucial to achieve our global climate targets and limiting global warming to 1.5 degrees. To address this challenge, AFID brings together industrial leaders, technology providers, and also knowledge partners to collaborate on decarbonization of industrial value chains, but also at the same time, how renewable-based solutions can be applied by the industry and how through this alliance we can contribute to support specific net zero goals of different countries. Here is a snapshot of the different benefits that we bring to our members through AFID. But most importantly, AFID is an industry-led alliance, and all our actions and activities are driven by our members. Being part of AFID brings different benefits to our members. For instance, sharing knowledge and also good practices, collaborate on joint activities through our different working groups, improve skills and capacity through our materials, supporting capacity building, and also engaging in dialogue with governments and relevant stakeholders at major events like New York Climate Week and also COP. And for instance, we also organize webinars like this one today, where we bring new knowledge and new insights for industry decarbonization. Very briefly, how the alliance works. Right now, we have 87 members and partners from across sectors and different regions. As you can see in the map, majority of our members are coming from Europe and also from the MENA region. And in the right-hand side, you can see we have a big representation from the energy sector and also from the industrial service sectors. An important aspect of our alliance is our decarbonization commitment. So at COP28, AFID members adopted a joint decarbonization commitment aiming to increase production and offtake of green energy, at the same time reducing Scope 1, 2, and 3, and also increasing investments in decarbonization projects and energy transition technologies. And to materialize this AFID decarbonization commitment, the members of AFID, they have individual plans to reduce greenhouse gases emissions, as you can see in this graph, targeting a 54% reduction in Scope 1 and 2 emissions and 43% reduction in Scope 3 emissions by 2030. And also one of our goals is to triple installed capacity, energy capacity, increasing from 183 gigawatts in 2023 to 534 gigawatts by 2030. Our members and partners, they also have projects with the aim to scale up bioenergy with CCUS, with a goal to capture over 40 times more CO2 by 2030. Also, they have plans to reskill human capital, meaning engineers, technicians, to almost 100% by 2030, and at the same time increasing financing, mobilizing financing for energy transition and decarbonization projects. And we do this in an annual basis. So every year we update these targets from our members. We have, the way we work is we have different focus areas in working groups. So we work in technology through renewables, bioenergy with CCUS, green hydrogen, and we also work in circularity, human capital, and finance. We have, the alliance is hosted by Irina and also co-chaired by Siemens Energy, and I'm still, as I mentioned, and each of our working groups is led by different companies. And also we have different members that belong to different of our working groups. We have different actions and activities, as I mentioned at the beginning. For instance, we have a knowledge sharing platform like MyChange. We also have an enterprise tuning platform with the goal of connecting different companies to support industry decarbonization. And we also publish different reports highlighting the key messages from the industry, for instance, in green hydrogen, VCCUS, and so on. And another key aspect of our alliance, we launched a technology showcase where we source innovative technologies that can be eventually incubated and implemented by the industry. So an innovation aspect is also important within the alliance. And as mentioned previously, we also are present at different events, global events, where we engage with key stakeholders, the governments, the private sector, and we bring the voice of the industry. For instance, we're present in New York Climate Week, COP, IRENA Assembly, and so on. And for that, I will finalize. If any member, any company is willing to join the Alliance for Industrial Decarbonization, these are our contact details, and we will welcome any of you interested to be a member. And yeah, with this, I will pass it to Alan. Thank you so much. I'm looking forward to this webinar.
Excellent. Thank you, Begonia. I reminisce that it was almost 2 years to the day that the COP28 presidency introduced our two initiatives together and encouraged us to work and collaborate, which we have done since that day. Excellent. With that introduction, that allows us to get to some of the, shall we say, meatier parts of our presentation. And it is my absolute pleasure now to actually introduce you to Maysam Kanani Amire. He's going to be giving a keynote presentation for us today on the topic of financing the energy transition for industrial sectors with emerging markets. Maysam is a distinguished senior member of Siemens Energy's Treasury and Corporate Finance Organisation in the Middle East and North Africa region. He's got over 13 years of dedicated service to the group, and Maysam has established himself as a seasoned finance professional and leader, specialising in treasury and financing with a particular focus on project and export finance. Please, if I could, Maysam, welcome to the stage.
Thank you very much, Alan. Thanks a lot. Good afternoon, ladies and gentlemen. Global investment in the energy transition has seen a significant increase since the Paris Agreement in 2015, with the spending projected to reach $2 trillion in 2024. Despite these advances, current investment levels are insufficient to meet the global climate targets outlined by the International Energy Agency. To align the energy sector with the net zero emissions by 2050, annual investment needs to increase to approximately $4.5 trillion per year, indicating a substantial gap between current and required funding. More financing must be channeled to developing countries and emerging economies, which receive just 15% of energy transition investment. Financing energy transition faces significant challenges globally and within emerging economies. These challenges include high upfront costs, increased risks, inflation, supply chain constraints, and interest rates. In addition, regional disparities pose significant challenges, with each region facing its own unique set of barriers to advancing its energy transition goals. Despite record levels of investment in the energy transition, most regions are falling short of what is needed to meet the climate goals. The gap between current investment and required financing is even more pronounced in emerging economies and developing countries. Addressing these challenges requires a standard approach to reducing the financing cost and to mitigate the risks of energy projects. Collaboration between investors, industry executives, policymakers, and financial institutions is essential. To effectively manage the energy transition, several key issues that impact the financing and deployment of energy transition projects must be addressed. Number one, energy security and affordability. A successful energy transition requires a delicate balance between security and affordability. Energy security ensures a reliable and uninterrupted supply, while affordability guarantees access for all. Number two, reducing financing costs. In developing countries, enhancing availability of long-term access to low-cost capital is crucial, and this can be achieved through concessional loans, guarantees, or subsidies. These tools help make financing more affordable and accessible for critical projects. Export credit agencies are also important elements of the equation in these emerging economies. Number three is de-risking innovative technologies. Innovative technologies with a strong business rationale but limited operational history require risk mitigation measures to become bankable. Governments and financial institutions can play a pivotal role in reducing or reallocating these risks through insurance and guarantee instruments, such as those ones provided by the ECAs. Number four, hedging off-taker risk. To reduce the risk associated with market fluctuations, it's important to ensure that offtake agreement protection is available through financial tools that guard against the price swings in the market. By managing these risks, companies can make their finances more stable and predictable, widening the potential pool of investors. And number 5 is mobilizing capital to emerging markets. Mobilizing capital for emerging economies on both debt and equity side is critical to achieving global energy transition goals. This includes the use of blended finance solutions, such as combining public and private funding through development finance institutions, concessional debt from governments, and regional or global ECAs in order to fulfill and fill the investment and financing gaps and to make projects more attractive to private investors. Additionally, robust mechanisms are indeed needed to mitigate the risks and improve the financial performance of energy transition projects. To name few of these mechanisms, we can allude to government support. Government support through measures such as tax incentives, grants, loan guarantees, and performance-based incentives is crucial for energy transition projects. This support helps bridge the cost and risk gaps between fossil fuel and renewable energy projects, aligning the goals of equity sponsors, lenders, insurers, and governments. In addition, a dedicated government funds that provide financing for technology demonstration and deployment projects can have a major positive impact on commercialization of innovative energy technologies. The primary goal of these funds should be to strengthen SMEs and promote new technologies and innovations to maintain the country's economic competitiveness. Number 2, revenue guarantees. Offtake agreements are crucial for the bankability of energy transition projects. Electricity and certain clean fuels like green hydrogen are constrained by local market conditions as the infrastructure to transport them across the whole continents has not been built yet. Conventional fuels such as oil or natural gas benefit from a fully integrated global market, so they can more easily find backup offtake solutions outside the country or region if they face issues with local offtake. Once technologies are proven and markets are established, financial institutions are more willing to offer support due to the decreased risk profile. The third mechanism is export credit agencies. Export credit agencies, or ECAs, are crucial for enabling companies to participate in international energy transition projects. Although ECAs have reduced financing for fossil fuel projects since COP26, the increase in renewable energy investment has not kept pace. Lenders are more likely to support projects with export credit guarantees due to reduced default risk, significantly lowering the cost of financing and extending the payback periods. A number of ECAs already offer special conditions for energy transition projects, offering lower fees, high coverage, and flexible loan conditions, allowing investment management optimization. Therefore, export credit guarantees have the double benefit of increasing revenue certainty and fostering trade and technology adoption across markets and in countries with higher risk profiles. The fourth mechanism is blended finance. By combining concessional finance from philanthropic sources with commercial investment, blended finance ensures financial viability by de-risking corporate investments for technologies, sectors, and geographies that are currently underfunded. Other sources of concessional financing, such as low-interest loans, public grants, and guarantees, can be used to reduce risks or improve returns for private investors, enabling funding for innovative or high-risk technologies. Blended finance is a dynamic and transitional tool that can step in before private markets can work effectively. So it's very vital that in addition to larger corporations, developers and SMEs are also able to leverage these funds. The fifth mechanism is sustainable bonds and loans. Sustainable bonds are an instrument that are already widely used. However, their impact can be significantly increased when they do not require underlying assets. Instead of being linked to a specific project, they can then be backed by an issuer's entire balance sheet. And as a result, these sustainability-linked bonds are considered low risk and can be issued at large amounts and with longer tenors than project-specific instruments. And of course, to ensure their climate impact, they can be linked to existing sustainability pledges, such as science-based target initiatives to guarantee the issuer's accountability. Ladies and gentlemen, the success of energy transition hinges on our ability to finance the energy systems of the future, ensuring that they are affordable, resilient, and sustainable. Access to long-term, low-cost financing is crucial to ensure the viability of this transition, with our primary focus on reducing both capital costs and the cost of capital. Achieving global climate goals will require significant investment, and this will only materialize if we focus on innovative financing mechanisms, foster international cooperation, and maintain regulatory predictability. Recognizing regional differences, reducing financing costs, supporting SMEs, and leveraging philanthropic funds are critical to this endeavor. Thank you very much for your time. Thank you very much for your attention. Over to you, Alan, and I'm open to any question and answer.
Thank you so much for that, Mason. A couple of your points really resonated with me there. The one that always hits home is the management of risk. And of course, these projects introduce so many new risks. But that's not where I'd like to go with the question. If we cut to the, what do you think that the financing community, and that includes both the banks and the ECAs, the export credit agencies you mentioned, what more can they be doing to actually support the financing of the energy transition?
Thank you very much, Alan, for this question. It's a great question, actually. So it's very important to address this question is very important to look at the triangle of affordability, reliability, and sustainability. And one thing is very, very clear. The gas and the transition technologies are in the middle of this triangle. So it's very important that we do not shut down the high efficient technologies and transition technologies overnight, but rather allow some certain time periods for transition technologies to play a bridge gap and to play a bridge role in order to bridge the non-efficient technologies to the efficient technologies and to the more renewable sources. And this is not going to happen without support of banks and ECAs and all international community to the transition technologies. So in summary, it's very important that lenders, ECAs, DFIs, and other members of the financial community do not shut down their support for high efficient transition technologies overnight, but rather support this in order to enable everybody, in order to enable societies to transition to a cleaner and to a more renewable energy. So it's actually the answer to this question lies in this triangle and the fact that gas is a transition technologies, and we at Siemens Energy would like to ask financing community, international development institutions, or let's say ECAs, to allow transition time for this technology, for the transition technology, gas or high efficient technologies of gas turbines, for example, to play a role of transition and do not shut down the support overnight. This is very important. Of course, many ECAs like Euler Hermes has done pretty good measures, and they're very supportive as far as we fall into the related criterias. But lenders are also supporting this, so we need more support from the financing community to just allow this transition to happen.
Excellent. It's an amazingly simple point, but incredibly important. You don't merge on the highway by instantly getting to the speed. You need to actually get that time to actually build up and seamlessly merge. Now, the topic of today's conversation is very much a heavy focus on emerging economies. So given that context, how do you see the role of regional ECAs and development financial institutions, DFIs, in supporting that transition journey for emerging economies?
Great. Thank you very much, Alan. Actually, I can speak on behalf of Siemens Energy and as an exporter. No point in time we've been observing a massive demand in the energy. Our business is more relevant than ever before, and these days we are really observing an increased demand in the electricity, and therefore Siemens Energy's technologies, Siemens Energy's products and services are needed more than ever before, and actually are relevant. Our factories, our manufacturing facilities in Germany are overloaded for the next couple of years, and we are really flooded with orders. Of course, probably you've seen our order backlog of 135 billion euros. So we really need manufacturing capacity for that. And with this huge and massive order backlog and demand for energy, it's literally impossible to source from, particularly in Germany, for example, to use German ECA or to source from Europe because our factories are overloaded. To overcome this challenge, we have resorted to an alternative solution with the help of regional ECAs being in the UAE, like Etihad Credit Insurance, that requires, for example, 20% of UAE content, or Isaac, which is part of Islamic Development Bank, or Daman in Kuwait. And these regional ECAs or DFIs are actually sourcing agnostic. So for Isaac and Daman, sourcing doesn't matter. And whenever we cannot source from Germany and we can source elsewhere, we go and capitalize on their capacity to either front any deal or provide reinsurance for our high efficient technologies and high efficiency technologies. So improving and capitalizing on the capacity of the regional ECAs is very, very important, because in the emerging markets and in emerging economies, normally clean appetite of the banks and lenders are not there. Therefore, they're looking for an insurance buddy or ECAs or DFIs to come and insure that. And because of the sourcing challenges, because normally international ECAs require certain sourcing requirements, because of sourcing challenges that we have, and because of the manufacturing capacity and constraints that we have internationally, we source from our factories elsewhere in the world, other than, for example, geographies where the international ECAs are located. And for that, we tap into the capacity of the regional ECAs, such as Isaac, Daman, or Etihad Credit Insurance, and we expect them to increase their appetite and their capacity for emerging economies. And it's very, very important to really use them together, of course, with international ECAs in order to be able to enable the energy transition.
Excellent. It's really important to always remember that one of the points you made there at the end, that when we talk finance, it isn't just about capital finance. Without an insurance element, you can't actually have the underwriting to even continue and operate the projects that we want to build. With that, though, we are on time. I would like, on behalf of the Net Zero Industries Mission and AFID, to give you an absolutely enormous thank you for giving up your time and sharing your insights with us today. Thank you very much. And with that, I will now move to our next speaker. But Mason, have an excellent day. I know you need to head off, but we'll be making a small change. It's our pleasure.
Sure.
Making a small change in the format for the rest of the sessions today. We'll be having speakers and we'll be doing a panel of discussion questions at the end of the next 4 presentations. So without further ado, if I could please introduce Hien Tran. Hien is a climate finance specialist with a track record of mobilising capital for climate and environmental projects and advancing sustainable finance across emerging markets. Now, Hien does this at the United Nations Industrial Development Organisation, or UNIDO, and she works on the topic of mobilising finance for NDCs and industry decarbonisation projects via innovative financial instruments. If I could please hand over to you, Hien. Please share your presentation.
Alan, From my side,
sorry.
Alan, I just wanted to thank you and the whole team for your great organization and for all the efforts you made. It was indeed a great pleasure for me to be part of this event. Thank you very much. And thank you very much, ladies and gentlemen, for your time and for your attention. Appreciate it.
The pleasure is all ours. Thank you so much, Mason.
Thank you.
Ian, if I could hand over to you, please share your slides. And we look forward to your presentation.
Yeah, so let me share the full screen. So good afternoon and good morning, everyone. Thank you for the organizers to have me here on representing UNIDO to discuss about this crucial topics of mobilizing finance for industrial decarbonizations in emerging markets. I would like to, after the very comprehensive overview shared by Mr. Mesam from Cement, I would like to deep into the discussion on the aspect of how we work with governments and different stakeholders, industry players, and others, DFIs, and others stakeholders in the market of industrial decarbonizations to mobilize and to facilitate the transitions in heavy industries. Just to recap what we all have heard so far about the emission gaps of the of heavy industry, steel, cement, chemicals company to actually decarbonize and provide and cut down the GHG emission rates by 20% in the next 10 years, by by 2030, and then 90% by basically net zero by 2050. Which this is the emission gap that the whole global industrial players have to keep to, and the focus of this whole transition is in the emerging markets because of the shares of the production lines and also the growing demand in the next decades for the emerging context. And we also want we are all aware of the big financing gaps and the actual market not readiness, lack of capacities, lack of finance to mobilize funding for industrial decarbonization projects. And when it comes to the sources of finance, the actual numbers in the past for the last 10 to 15 years indicated that climate finance was not directly focused enough to facilitate the industry transitioning. Most of the fundings for climate finance so far are mostly focusing on the energy side of the equations, not yet on the process change and decarbonizing the middle value chain of in construction materials and other kinds of materials manufacturing industries. And because for now we are talking about the context of EMDEs, emerging markets and developing economies, I would like to highlight the recent discussions from OECD colleagues when running the scoping of the barriers for assistance to industrial decarbonization projects. The scoping highlighted key challenges in terms of market risks or perceived market risks, lack of viable projects, which related to the pipeline of the projects on the ground, and two others key barriers in terms of policy and currency. So it's more related to the macro elements of the industrial decarbonization projects in EM context. And what I would like to highlight in terms of like how we see the key elements of strategic finance strategic finance framework to support the transition of the industries, particularly heavy industries in the context of the emission targets, would focus on certain points. The first part is about the high-level signaling discussion. Ideally, we hope to see, and we are supporting countries, working with developing countries to enhance their NDC targets to be more ambitious in terms of the sector's aspect, and also to ensure that and the NDC targets are implementable and also investable. And the topics of having clear kind of signals from the government side in the NDC targets for industries is one of the critical starting points to make sure that we can set the foundations to attract more finance to this topic. So that's the number one intervention, I would say. Number two, the elements. Number two, that we perceive as one of very enabling factors to support mobilizing more finance for industrial decarbonization is the fact that we should have sectoral roadmaps, customized, tailor-made to the region specific and the country local context specific. So for now, most of the discussions are based on the IEA's net zero roadmap, and in order to be able to effectively loop in the developing countries and also industrial players in the local context, in the emerging markets, to be on board with these kind of high-level roadmaps, we need more tailor-made and regional-based kind of approach. So, for example, in the slide you can see one example from FISEM, which is the Cement Association of Latin America, when they discuss about their roadmaps and what are the levers in terms of both policy and both the finance side. That's number two. Number three, it is very critical to have a comprehensive policy framework for these certain industry and industrial sectors to be able to make the business case to attract more finance. Basically, what we are looking when we talk about industrial decarbonization projects for heavy sectors, it's about mostly construction materials, building materials, and those kind of commodities are limited in terms of like the price. There's not like a clear there's not yet a clear roadmap and plan and guidance in terms of the green premium we should have for these kind of middle value chain commodities. So we would like to focus on supply side regulatory measure, demand side regulatory measure, specifically focusing on green public procurement, which is something UNIDO is working on. And also we discuss with the policymakers in developing countries about helping to set up their direct funding and incentives mechanism to support these efforts from the industry. Number four, when we talk about the transitioning of hard to base sectors, now heavy industry sectors, similar to what Chairman was mentioned, we need a transition period, and to be able to enable that kind of support from different sectors, from the banks, from the governments, for companies to do the transition itself. The taxonomy is critical, and the taxonomies that have discussions about eligible transitional activities and projects, something that currently only a few most advanced taxonomies, sustainable finance or green finance taxonomy involved with this topic, including the EU, Japan, Singapore, the ASEAN, and then climate bond initiative still criteria, which is market-based kind of taxonomy to define what does it mean by transition projects in steel, cement, and chemicals. The point we want to, although UNIDO is not directly working in this particular topic, but then for the discussion of a strategic finance approach to mobilize funding for industrial projects, this is a topic that we also would like to we keep track of, and I just want to flag it in the discussion because without a taxonomy to define this kind of activities, it's very difficult to mobilize both public and private finance. Yeah. Yes, and the final 2 points I want to mention here is the fact that number one, we want to mobilize more finance from the global north to the global south. So this is the context of institutional investor moving their capital to the emerging markets, and this is some the progress of this discussion is still going on because there are lots of there are lots of constraints that we need to understand and unlock, and then the MDB and IFIs are crucial in this discussion. And finally, we want to talk about the global landscape for technical and financial assistance for industrial decarbonization, and the importance of international collaborations in this context, which includes the different alliance and platforms and funding programs. Finally, I just want to highlight that in order to mobilize finance for industrial decarbonization in emerging markets, we need a comprehensive chain reaction kind of design, starting from enabling environment to financing the projects, to scale up the portfolio of investable opportunities in industrial decarbonization kind of pipeline, and finally to support the underlying performance and an underlying system to help the country to mobilize their internal domestic funding for to support the transition. So this is basically the key levels that will summarize everything I mentioned before, because whenever you heard about these discussions, it's always about the financing instrument, always about the blended finance, about the fact that we need a lower cost of capital. But then in order to be able to do those kind of outcomes, we need a policy framework, we need the capacity of the stakeholders, we need the data, MRV, and also the transparency of the data itself, and finally we need international cooperation. I just want to end the intervention with one final thought on the fact that sustainably speaking, if we want to ensure that we have long-term lower risk kind of financial flows for industrial decarbonizations, local currency financing in the emerging markets is a very important topic. Yeah. So and then currently this is also an ongoing process, and it's a macro effort for the long term, but it's worth looking at and keeping tab to. Yeah. So thank you for your attention. Yeah.
Thank you very much, Ian. Just to reassure everyone watching, the video of this presentation will be available on our YouTube channel afterwards, and the presentations will be available for download on our website. So if you missed some of the details on those slides, you will be able to access them later. Now, the format of our presentation today is very much that we have a panel coming up after our speakers. So while I have some very good questions for you, Ian, I'm going to ask you to hold tight and be ready, because we're going to jump next to our next presenter and leave those questions for the panel session. Now, this is a very special welcome for Tien Nguyen, and I know that you've woken up very early in the morning there in America to join us. So thank you so much for coming to join us. Tien is the global lead for the Climate Business Department at the International Finance Corporation, and he's based in Washington, D.C. Toyin leads global initiatives on climate advisory, investment mobilisation and specialised programs such as the Eco-Industrial Park or the EIP certification, green hydrogen, climate trade and supply chain finance, as well as methane reduction. Please, I'd like you all to welcome Toyin. Please share your slides and welcome.
Sorry, good morning, everyone from Washington, D.C. Can you see my slide?
Absolutely perfect. Thank you.
Great. Look, thank you again for inviting IFC to present. I just want to take maybe a big step back in sharing some thoughts. Obviously, first to introduce IFC, the International Finance Corporation, we're part of the World Bank Group. So poverty reduction and sustainable development is at the core of our mission. Obviously in recent years, these objectives are threatened, and there are also opportunities linked to climate as well as climate opportunities. But oftentimes, when we look at solutions, we tend to go straight and really just focus our effort on thinking about cost of capital, thinking about technology, thinking about trade policies. But I just want to use this opportunity to reframe and think about when we look at these difficult problems and their solutions, we really have to anchor, definitely from IFC World Bank Group, how these things help the countries and help the people in the emerging markets for better jobs, support SMEs, mobilize more capital and investment for development. And so it's not just a capital solution or it's not just a technology solution, but really at the end, it's how do we support people. Let me just start with addressing perhaps the elephant in the room. We all live in a very different geopolitical space. And sometimes, one may be a little bit more pessimistic about the trajectory of climate solution. But maybe just a couple of things to share, at least that keeps me optimistic. When I look at the SBTI, the Science-Based Targets Initiative dashboard very regularly, what you see is still a very strong commitment by corporates around the world on net zero targeting, on validated targets, those with net zero targets, those with active commitments. The curve has really spiked up in the last few years. Perhaps there's, like everything, some ups and downs, but nothing has fallen off a cliff. So this is the first indicator that whatever geopolitics we live in, the demand for climate solutions, because there are good business solutions, they remain very firm and continue to grow. The other indicator is on just taking a look at sustainable debt, whether it's green financing or green bonds or sustainably linked financing. Again, the trajectory has grown very fast in the last 5 years. And while there are some variations in the current time, that trend is still on an upward path, especially when you look at markets like Asia. The amount of green financing, sustainable financing is still growing. Again, this is a second indicator that whatever geopolitical environment we are in, the business community and the financing community remains very committed. This may be one last thing to share. As part of one of my portfolio, I lead the industrial certification for Eco-Industrial Park, which we're developing. This actually work that we developed earlier together with UNIDO and ZIZ. So in the last 6 months, traveling and talking to a lot of industrial parks across the world in Mexico, Dominican Republic, Morocco, Vietnam, Philippines, combined with the current reality of certain trade actions or trade war that's happening globally. I was very encouraged to see and to hear that from all these industry players, the looking for solutions on green energy, on green buildings, on green processes, efficiency, water recycling, etc. All these remain very much top of mind as these industrial parks look to expand and attract more tenants for greener global value chain. So all in all, I just want to really anchor, what we do in the reality, but it's remain optimistic in that it's still demanded by business and it's still good for business. So with IFC, maybe two things from the slide here. We want to play a catalytic role in finding solutions to mobilize, to de-risk, but ultimately mobilize a lot more partners in order to scale out the solutions. Because at the end of the day, if you look at, while we have ramp up our climate investment from 10 years ago, the ultimate number is still very small. We are a catalytic player, but the requirement, I think, as mentioned by other speakers before, requiring trillions, if not hundreds of billions, these things require a lot of other partners to come in, and especially for emerging markets, a lot of other policies and financing, both global and domestic, to make it happen. But from our part, we have now basically all of our projects are 100% Paris aligned. Our KPI for climate projects is at 45% of all the investment we make, and it remains those strategy. But what is changing is we recognize the need to mobilize a lot more. Typically, we mobilize maybe 2-3 times what we finance, but that multiplier needs to be in the 10x more in order to then bring in a lot more partners in order to deliver these financing solutions. So on this list, many of these items have been covered by the other panelists. So let me just talk about when we talk about technology costs and regulatory challenges. Take example of green hydrogen. We really have to look at it from a whole value chain perspective, where you look at, let's say, on the energy side. Perhaps in many countries now, fortunately, the renewable energy scale out has been very impressive and cost has gone down. But then on the processing, on the electrolyzers, the reality is that 90+% of electrolyzers are manufactured and exported from China. And so how do you have a more diversified sourcing of electrolyzers more globally, and then also bringing up to scale as what China is able to do to then lower the cost of that midstream processing. But then ultimately looking at the offtake that Masram mentioned. And in the offtake at this point, you need both the blended finance for catalyzing the viability costs on the whole process, but you need more regulatory support on carbon tax. And this at domestic level in emerging markets, oftentimes it's very challenging. But then there are other mechanisms like the CBAM from EU and other where this enabled basically a high offtake for a process that remains a little bit more expensive. And on the opportunities in terms of looking at how we can drive these measures, perhaps I'll focus on the last two bullets, where at the end of the day, when as we work exclusively on project in the emerging markets, the incentives cannot be simply a global objective of reducing carbon for global climate change. I think that's a global collective challenge, but at the local level, at the country level, really it's about how do these expensive, large, complex, hard to abate industrial projects, how do they help the country to develop? So thinking about the development of these sectors in each country, especially in terms of economic growth, better trade, but really linking them to how they create jobs directly in these industries, as well as across the whole value chain, and creating more value added ultimately for export. This is something that can be much more attractive to domestic policymakers rather than some global objective that may seem much harder for fiscal action at a domestic level. And then, we see elements like green hydrogen, countries like India and others. The big push for this is that of energy security, where the countries that are basically net importer of fuel really see these new solutions as the way to become more energy secure. And so the combination of domestic energy security and creating more and better jobs, these are the real driver that can get individual countries to take actions on fiscal and trade support and even carbon pricing in order to move along the hard to abate solutions. Lastly, I just wanted to share some examples that we're working on at the country level, just to give a snapshot of where we're looking at, especially for green hydrogen projects in Brazil, Morocco, and India, especially. And the one highlight here is, obviously all these countries have their own industries, and for a new technology like green hydrogen, the first is having very strong renewable in country, but then linking them very closely to their domestic industry, especially those that are already using gray hydrogen, like ammonia and fertilizer, and then replacing it with green hydrogen, where you offer then the energy security, you offer then the ability to create an end product that is globally tradable, that perhaps not cost effective at this point without blended finance, but offering a much lower carbon profile that become cost effective in markets where carbon tax are higher, especially like in EU. So the final point again is, and these are of course very big picture. I think other colleagues have shared a lot of details on the financing gap and the technology gap. But for us, really anchoring what we do to bring in these solutions through developmental impact at the country level, at the jobs level, at the beneficiary level, because otherwise it's the broad climate agenda will not be delivered if you don't have buy-in at the country level. And oftentimes at the global north, when we work on climate solutions, we sometimes mistaken the headline of carbon reduction and technology deployment, whereas the headline really should be about economic development for country to become richer, and especially creating more and better jobs in those countries, and working on the climate solutions for hard to abate sector is a way to deliver those ultimate objectives. So thank you very much for IFC to be able to share this high level presentation, and looking forward to the panel. Back to you, Alan.
Excellent. Thank you, Tien. Again, I will hold those questions off. I'd love to ask them now, but I'm going to hold them off for the panel. But it was very refreshing to actually see such a diversity of projects being invested in there, not just in their geographical locations, but also in the types of projects. With that, though, it's my pleasure to introduce our next speaker. and that is Bratton Roy, who's actually going to be talking us about closing the trust gap to de-risk climate investments. Bratton is the Global Head of Decarbonisation at TÜV, and I hope I've pronounced that right, a global leader in sustainability assurance, testing, inspection and certification. He is also the chair of the AFID Green Finance Working Group, leading cross-sector discussions on unlocking green financing for small to medium enterprises and projects in emerging and developing markets. Please give him a warm welcome. Bratton, please share your slides and over to you.
Thanks, Alan, and good afternoon and good morning to some of participants here, which is really appreciable. First of all, on behalf of our Green Finance Working Group of AFID Ardena, I would also like to give a warm welcome to all the people who have joined today. And today, especially on this World Environment Day, which is definitely a global reminder that our planet's health is inseparable from our future. But I think it's a very timely and urgent that we are talking today on this topic of green finance. And not just how we fund sustainability, but also how we shaped the entire financial system to serve people, planet, and prosperity. So I think it's a very pertinent topic to talk today. And what I'm going to speak next 8 minutes or 10 minutes is some ideas of how we can close the trust gap to de-risk the climate investment. And as at the very beginning, we have seen from the keynote speech also that the key word here is the trust. And we also, in my position as the chair of Green Finance Working Group, we always discussed about this investment topic, and this trust always come there. And from our background from TÜV, being one of the oldest certification and standard company, we feel, and I feel that there are policies, framework, and standard which can help us to de-risk investment risk. And although there are many, I put down few points here when we are talking on the landscape of policies, framework, and standard, and which can be audited, which can be done assurance, which can be evaluated. Now, for ease of clarity, we segregate it into 3 areas. First, financial disclosure and risk management. Why it's important? Because frankly, green finance is no more like a CSR initiative. It's had its own risks and opportunities. And the regulatory landscape and the regulatory development is actually unstoppable. So there are so many new regulations coming, new policies, new rules are coming. So there is also a need of new standard and guideline and disclosure and risk management. And if we talk, we were listening about carbon and climate just before. So if we only think on climate, then climate related financial risks is become a mainstream risk management tool now. So it can be physical risk management, it can be transitional risk management. So financial disclosure and risk management is important. Second part is impact measurement and reporting. Why it's important? Because impact measurement and reporting nowadays, from whether it's is ESG rating or whether it is impact intellectual or forward looking, it's always important that to bring credibility. And in this particular green financing segment, credibility is basically the currency. And that's why the impact measurement and reporting is important. And there are various policies and framework and standard are there. And the third vertical, it's basically impact management and valuation. And I think it's a very important areas for de-risking, because green finance must go beyond compliance, I would say. So it should create towards value creation. And when you are talking that it should enter into value creation, that means that its impact need to be managed and valued. So that's why it's important. And one of the example, for example, is that there are a lot of nature-based project and financing on nature-based solution, and where nature and social equity are actually coming as the next frontier in anyhow. So biodiversity credit or regenerative agriculture, just in transition finance. So these are certain tools for which can create impact. And for that, there are various standard. So we segregated this standard. I'm not going into details of each, but the material will be shared. But we already heard from IFC just before my presentation on impact management and valuation part. Then you can see known name like UNFCCC, or on standard and method part on financial disclosure, IFRS, IFRAC. So as this will be distributed, so I will not go much details there. Now, coming to the next portion, that when we are talking that trust and building integrity through policy framework and standard, um, we just give an example of three, and I will not go in the detail. So if you see IFC first, and already we have listened IFC, so maybe I start with UNFCCC. If you see UNFCCC reporting requirement and enhanced transparency framework, which is definitely target user is a bit different. Target user is developed countries and developing countries. And there are a lot of integrity factors are already built up. And where it requires party meets the country, to report the national or GHG emission, then build system of measurement, reporting and verification, and then alignment with development countries' priorities and need. And then there are many topics. We identified few topics like GHG is important, progress tracking, impacts adaptation, financial technical support, or MBIs like say carbon tax. So these are the topics already included there. And same if we come for the private companies. One of the example all of us probably know, the CDP, for example, and there is integrity factor already established, like establishing voluntary framework to disclose environmental information annually. Then they also provide benchmarking system for investor to assess climate risks and opportunities. So these are, and in my earlier slide, I have shown quite a lot of standard and framework. If you go there, in every one has certain integrity factor, which is already built there. One very important part which we are discussing from the beginning today is the barriers of industrial decarbonization and impacting stakeholder and economy. We try to put it in the three areas because shareholders, all the stakeholders face challenges, investor and buyers. Obviously, the biggest barriers and gap probably how to perceive the risks due to lack of data and market uncertainty. We talk quite a lot on carbon credit. But there is a discussion of lack of evidence of carbon credit integrity, which definitely put a risk in the investor or buyer's mind. Then carbon market technological terminology hinders quite a lot of understanding. If we talk on the project developer or seller side, who will finally, if I talk climate or carbon, they will sell the carbon credit, but there is a lot of barriers and gap related to the methodology which can demonstrate the integrity of carbon credit to target a stakeholder. Then financial terminology often create a barrier because there are a lot of financial tools, there are a lot of mechanisms there in certain methodologies of, if you talk on carbon credit project, there are tools and there are terminologies which often are not so understandable. Now, the third part, even a sector like us who does independent validation and verification, we also face barriers because certain times there is a definitely lack of collaboration of deep and technical expertise between various stakeholders, which create a gap. Second, which biggest problem we also face many of the time, there is lack of publicly accessible data to validate and verify the claim, for example. So do you depend on second party? Do you go down and check every information and claim? It's a question. So challenges are everywhere. But to come towards conclusion, then what is important? The important is to develop an accessible system for integrity, because integrity is definitely a foundation, but accessibility or access is basically the enabler. So it's important to design for decision makers, not for disclosure. And to that part, and this is also we discussed in our working group quite a lot, that we must build a platform which will make it easy easy to translate sustainability performance into financial decision, whether it's credit risks, whether it's investment viability or impact ROI. And that's why these three is important to make usability, effectiveness, efficiency, satisfaction, to have a proper presentation of faithfulness, completeness, and the last is relevance, which is more significance, informativeness, and resonance. One important part, as we are quite engaged in validation, verification, carbon credit, I think it's important, and there is a direction there, that interpretability on standard alignment. So there are a lot of standards related to if integrity portion from Article 6, ICVCM or VCMI, but to reduce this fragmentation, harmonization is required. For sake of time, I will not go to this case study, but I will conclude and I will come to my last slide. So what we feel is that there is a gap in the carbon market ecosystem or in the green financing ecosystem, but it needs to be addressed by prioritizing usability in the standard, policy, and framework design. And when I'm talking on prioritization during the design phase, basically a couple of things is important, like first, avoid hurdles further down the timeline, because we have also seen that there is a timeline and there is a change in new requirement. One of the example is EU Omnibus rollback. So there are certain timeline got changed, whether you are talk CSRD or CBAM. Second important part, I think, which I want to mention in the last minute, is that it's important to ensure the critical stakeholder like emerging market and development economics in this green transition are included, and they are leading this transition. Because inclusion is actually not an optional, it's basically prerequisite for a credible green financing system. And as we all understand that emerging market must be on the forefront, not in the sideline. And when I'm talking leading this transition, leading means being bold, innovative, and transparency, and form a sustainable link instrument and transition finance. Last but not the least, digitalization is important. It built up the trust, and because data ultimately give you the trust, and there you need digitalization, real-time tracking, and user-friendly access. So that's very briefly our view from our company, as well as my view on behalf of our Green Finance Working Group. Thanks a lot.
Excellent. Thank you so much for that, Braden. I think it's a really critical point there. One of the points you made there about stakeholder engagement, and you gave us some good insights there into the different needs and mindsets of some of the critical stakeholders that are going to be involved. But you can't deliver change without engaging and bringing those stakeholders along and helping them find that true ownership that's needed to help deliver those changes. Again, holding off for our panel discussion with questions, but our next speaker, if I could have the honour of introducing, please, is Joseph Cordonia. Now, Joseph works at the Organisation for Economic Cooperation and Development, the OECD, in the Environment Directorate. In his current role, he supports the development of policy measures and financial instruments to scale up investment in industry decarbonisation and clean hydrogen in emerging economies. Joseph, if I could please welcome you to the stage to share your slides. We look forward to your presentation.
Thank you very much, Alan, and thanks to the organisers for having the OECD presents today. I hope you can see my slides.
It's working perfectly, yes.
Yeah, so I will present today reports that we have been preparing at the OECD for the Climate Club, which is a toolkit on economic de-risking and financial instruments for industry decarbonization. So a brief introduction on the Climate Club, which is an open and inclusive forum of currently 46 member countries, including around 20 emerging markets and developing economies that are working together in order to accelerate the decarbonization of hard-to-abate industries, focusing primarily on steel and cement, and doing so through three main pillars of work. The first one is to advance on climate change mitigation policies, with the main work being on carbon pricing policies and spillovers. The second pillar focuses on transforming industries, notably through definitions and standards for low emissions material. And the third pillar is on boosting international climate cooperation, in particular on the financing side. So the OECD, together with the International Energy Agency, co-host the Secretariat of the Climate Club and also provide and prepare content material and knowledge products. And the Climate Club Financial Toolkit that I will be presenting today is part of the work developed under Pillar 3, with a few other deliverables that I'd like to mention. We have also prepared last year a mapping of financial and technical assistance for industry decarbonization, highlighting, for instance, the role of official development aid, the role of international finance institutions, as well as philanthropies in financing the decarbonization of industries in emerging markets. And the Pillar 3 also includes the development and launch last year during COP of a global matchmaking platform, whose secretariat is ensured by UNIDO. And the main purpose of the global matchmaking platform is to collect requests from emerging markets and developing economies for financial and technical assistance, and put them in relation with a number of delivery partners and governments that may support them in their efforts to decarbonize their industrial sector. So the main purpose of the toolkit that I will present today is first to inform financial and technical assistance providers, and that includes countries, but also multilateral development banks, export credit agencies, and a number of actors that have been mentioned in other panelists' presentation, to identify and select instruments that can help accelerate industry decarbonization. And we're trying to do so by providing a compendium of instruments with a clear categorization, easy to access, and with the support of multiple examples on how these instruments have been implemented in various countries and in various sectors. A secondary objective is also to support industry actors and project developers to build business cases. And the main items in the toolkits that support this is that we are showcasing which institutions can provide diverse instruments, and also illustrating those with how instruments can actually improve levelized cost of production for low emissions material, and how they can reinforce business models. So the toolkit is currently structured in 3 main chapters. The first one is providing an overview of instruments, which I will present clearly. And these are classified under 3 main elements. So other panelists mentioned, for instance, the importance of enabling conditions, institutional frameworks, etc., which are covered in other Climate Club deliverables. But here we are focusing on, I would say, instruments that directly impacts investment and create, I would say, direct cash flows for the projects. So first, economic instruments, which can be implemented mostly by governments in order to stimulate investment of other actors. Then de-risking instruments such as guarantees. And finally, the financing instruments, which are the ones providing, I would say, direct support and direct financing to projects. In the second chapter, we have collected 20 case studies to show how these instruments are being implemented to support decarbonization projects. And in a third chapter, based on OECD work and engagement with a number of countries, we illustrate for specific technologies across the steel, cement, and petrochemical sector, how combining instruments can help reduce the levelized cost of production of low emissions technology and bring them at par or close the competitiveness gap with the current conventional options and conventional production routes for these materials. For the next 2 slides, I will just pass very quickly. many of these items have also been described in details by other panelists. So you can see here the close to 30 instruments that are covered in the toolkits. What is important and what also gives hope is that for most of these instruments, they are already available and provided by a number of institutions, not necessarily for the industry sectors, but they can also be replicated there. And a key lessons that we have here is that even though we present this as a series of instruments, when establishing and building business cases for innovative projects, for instance, for low carbon steel or low carbon cement, it's extremely important to usually combine instruments in risk mitigation packages or financial packages. And in the current slide, you can also see here just a list of case studies. Again, this is, I won't go in detail here, only to highlight that many instruments are already covered. You can see a diversity of actors from government, international finance institutions, private banks and insurance companies, export credit agencies. So really a large diversity of actors, and also quite a wide coverage in terms of geographies. As you can see, for instance, for emerging markets, that we have the example of H2 Global, which whose first auction helped to finance a project in Egypt. We have examples to support India, Central Asia, Brazil, so almost all continents and diversity of emerging economies. From these case studies, maybe 4 key categories of lessons that we would like to highlight here. The first one is the necessity to build enabling conditions for the economic de-risking and financing instruments to be impactful and to be effective. And therefore, the role of institutional readiness, the role of sustainable taxonomy is key in order to make the financing effective. In terms of instruments themselves, as mentioned by colleagues from UNIDO, we are also supporting, thanks to the example of the case studies, that the role of direct public support is usually for first-of-a-kind plans, targeted time-bound uses, as the public resources are extremely constrained, and this is particularly the case in emerging markets and developing economies. And we'd like to emphasize as well the role of de-risking instruments to optimize the resources. And this is particularly important in emerging markets where the cost of capital is high, and where not having a risk mitigation package can actually increase the total cost and total resources needed for given projects. 2 other categories of key learnings: the cooperation. So I mentioned the global matchmaking platform that has been created by the Climate Club, but more generally, multi-stakeholder approach, collaboration between public and private sector, and matchmaking platforms in order to create pipelines of projects and match them with finance provider is extremely important. And paying a particular attention to the replicability and scale-up of instruments is key. The first case studies we see are very recent, so they support often first-of-a-kind projects, or they are innovative in the sense that they are testing some applications of instruments for a given sector. But the goal is also to create sustainable markets that are also self-sustained. I will go very quickly through the following slides, just to highlight that the last part of the toolkits shows a number of illustrative economic assessments of various technologies across sectors. And just to have a brief overview, we highlight a bit the value chain of each sector, highlighting where technologies can be implemented in order to reduce emissions, so having environmental impacts, and then looking in various scenarios, here mostly through carbon prices, but we also test the effect of tax reliefs, the effects of capex grant, contracts for differences, etc., on the profitability of low emissions technology versus the conventional production routes. And the last slide on the next step for these projects. So we are currently collecting additional case studies from various organizations. We will also make use of it to update the toolkit, not only with case studies, but also beefing it up with a first introductory chapter that will explain what are the key challenges and the key approaches to finance industry decarbonization in emerging markets and developing economies. And all this will be compiled into a full OECD report by the end of the year. And we'll organize a workshop bringing together all type of stakeholders by the end of the year to assess with them how the toolkit can be used by countries, by financial institutions, and by industry actors to actually implement those instruments, scale and replicate them. I stop here. Thanks a lot, Alan. Over to you.
Thank you so much, Joseph. One thought that comes to mind is that while we say that it takes a village to raise a child, one big takeaway for me over the last few years is to recognise that it takes a value chain to embrace a technology. They aren't transactions, they're not isolated events or decisions. And those value chains are going to become, I think, far more, shall we say, influential in a lot of our decisions. Now, in the next stage, so thank you very much for that presentation. In the next stage of our session today, we are running a little bit behind time, so we might just ask that we're slightly briefer than we would normally be in the answers to the questions. But I'd invite all of our speakers to actually turn on their cameras, and we're going to move to a panel discussion. I have questions that I've been backing up and holding back on here. We're going to be running this panel session in 2 rounds. In the first round, we've got a theme, and that is to actually lay the groundwork to highlight the major developments, the innovations, and the coordination mechanisms that are actually going to enable green finance in emerging markets. And I've got a question for each of you. I'm going to mix up the order a little bit, and I'm going to actually go to Bratton first, if I could. You put as your final point there about digitalisation. So how does digitalisation of the monitoring, the reporting, the verification processes, how does that impact organisations' access to green financing?
Well, I mean, first of all, as I mentioned in my second slide, that when we are talking on green financing, we also need to see the indices of green financing and the impact, and how you measure the impact. To do that, you need data, and you need monitoring and measurement of the indicator. Now, if I take one example of carbon financing, because we talked quite a lot on this topic last 1.5 hours, if you take any classical carbon credit project, and for the integrity purpose or for the monitoring measurement purpose, every project, there is a methodology. And this methodology requires quite a lot of monitoring parameters. And often the problem is that many of the time projects are not as simple, like there is a photovoltaic plant and you have 1 meter and you are getting data. And then if you consider a community level project, a cookstove project, if you consider a nature-based solution project, there is multiple geography, there is a decentralized energy system, there are different community level, and you have multiple data. You can do it manually, but it's definitely not sustainable. So, and to get more credibility and trust, I think digital MRV is one of the best solutions which can integrate from the various sources from the entire value chain. And when digital MRV is linked with project developer, a verifier, as well as the agency which is issuing carbon credit, that would be the perfect solution. And that is probably needed to bring integrity and trust, because then you know that after 5 years or after 7 years, you are not losing some data which can impact your investment in future.
Excellent. I don't disagree with you at all, by the way. In fact, digitalisation is one of the 7 key technology pathways we prioritise as part of Net Zero Industries' mission. For my second question, I'll jump to Joseph, if I could, please, putting you on the spot here. From your perspective, what is the role of international collaboration and technical financial assistance in accelerating decarbonisation in the emerging economies?
Thank you, Alan. Of course, international collaboration can basically support in all aspects of decarbonizing industries, but I'd like to focus on three main items that are salient barriers in emerging markets. The first one is on the technology partnerships, especially for some deep decarbonization technology. There are a limited number of technology providers, engineering companies that can integrate complex projects, for instance, the revamping of steel plants or carbon capture, storage and use. And therefore having this international collaboration on technologies, construction operation is absolutely critical. And we have seen, for instance, an example lately with the high iron projects that has brought together German and Namibian companies in order to bring a pilot DRI plant for iron making. The second one is for me to overcome the market barriers. From the analysis we have done at the OECD with investors, we have seen that markets issues were the highest barriers deterring investors from decarbonization projects. And international collaboration can help first in enabling, implementing enabling conditions for market creation. So typically on standards and definition for low emissions goods, trying to build on either agreed upon definitions or at least interoperable definition standard certification systems, but also on offtake. And offtake is a major risk as very few actors are ready to pay green premiums for low emissions material, for instance, and having access to international markets, having offtake agreements, having cooperation agreements at large that enable to, I would say, to provide benefits both to the emerging markets and developing economies that can benefit from industrialization and advanced economies that can also benefit from this low emissions good to decarbonize their economies is absolutely critical, and to do this in a, of course, just and balanced way. And the last part is, of course, access to finance. And I like to emphasize access to finance at every stage of the project lifecycle. A number of industry players in emerging markets struggle to even finance, for instance, the development cost of technologies or development studies, and their international philanthropies, official development aid can play a critical role. And of course, when scaling up, other institutions can also step in, including multilateral development banks, in order to provide the necessary capital for these capital-intensive projects.
Excellent. Thank you so much for that. My next question, if I could, I'm going to actually address this one to Tian. And I'm hoping the sun has come up there in Washington, because I know we're still very early. How can financing the green transition, especially from and to the private sector in the emerging markets, how can that advance an inclusive climate agenda by creating more and better green jobs for local communities?
Yeah, thank you, Alan. I think to your point, exactly looking at the whole value chain. To be candid, when you sit in a financial institution such as IFC, the default is looking at projects where you look really just behind the fence, and you then go into the technology, the business side of it, the financing, and oftentimes you do take an effort to look at the whole value chain. So I fully agree with you on moving green financing solutions through the value chain. So one example, for example, we're starting to look at a lot more deliberately how climate projects generate jobs directly as well as indirectly through the value chain. So we're working with the World Bank on conducting various global as well as country level studies, really driving at the heart of the benefit. One of the key benefits is, more and better jobs. So one report that's coming out in Vietnam next week actually is looking at 3 sectors, including solar. And this is on a inclusion in terms of women in the leadership role in these solar companies, as well as employees. And what you see, even in Vietnam, where the gender equity is quite good, across education and jobs, when you look at these new green sectors, the gap between men and women having access to green jobs become quite big again. And perhaps one of the underlying issue is access to STEM education or skills, vocational training equally among men and women. And so having these deliberate lens on how green projects are not just looking at from a project financier perspective, but look at the whole value chain, really taking a look at how these things generate jobs and then access for jobs equally in the economy. I think this can drive better solutions, because at the end of the day, let's say take again the solar sector in Vietnam. For that sector to really be successful, they're going to have to be able to bring in as many good skill workers at the leadership level and at the production level, operating level, and to not recognize that there's a gap where half of the population somehow isn't enabled to be part of this new sector. Then it actually poses a big risk on that sector developing in a very good, sustainable way. And my final point being again is, when we talk about solutions for climate, often we talk about it in a global OECD, global North type of perspective. Of course, climate affects all of us globally, but then a lot, predominantly climate solutions need to be at the emerging markets level, and those discussions need to be very grounded in domestic jobs, domestic SMEs, domestic value chain, domestic ability to export, because that's then really can drive the incentives for those actions to take place, not just simply from a global North type of, what do we want to save the world, and everyone else has come on board simply because. Thank you.
Excellent points. I have a daughter myself, so I'm not interested in watching to see if we can break those barriers. I want to be involved in helping break those barriers. We all need to be involved to solve it. Last question in the first part of our panel is obviously to Hien. Last but definitely not least, how has the landscape of climate financing changed in the past 2 to 3 years, particularly for industrial decarbonisation projects from your perspective?
Yeah, thank you, Alan, for the questions and also for all the great sharing points from all the speakers. Before me, I totally agree with all the points about digitalization, about the just and transition, high value chain-based transition, and looking not just to the projects, but to the all the value chain and social aspect of the whole investment. In terms of like climate finance per se, for the last few years, what we recognize is number one, the flow of climate finance flowing to industrial sectors, and specifically industrial decarbonizing kind of projects in heavy industries are not yet enough, and there's now ongoing efforts from the donor side as well as the global community to promote more funding from the public's funding ODA side to technical assistance program promoting knowledge sharing and learning and then technology transfer included in all these recent efforts in the global matchmaking platform and the climate club, for example, in this new pledge in the COP29 about scaling up international assistance for industrial decarbonizations by the UK and Germany. These ongoing efforts aim to promote an enabling condition. Again, that's the keyword to help the country to have a long-term stable track record for the transition in the long run. And of course, that discussion would like to focus on the domestic landscape to help the country, the developing country itself, to recognize the opportunities and then to overcome the barriers to have a long-term sustainable pathway for industrial decarbonization. And in addition to this kind of ongoing effort, recently the CIP, the climate investment funds, also launched a new program to call for proposals to mobilize, to provide more direct finance to the catalytic kind of projects and programs in the country's level. So they prioritize the whole economic approach and provide the funding to support these kind of interventions. Other than that, others ongoing efforts from GCF, from MAF, and from multilateral banks like the World Bank and EBRD are also promoting and fostering the pipeline development side of the project itself, so that they enable the whole system, from the government to the industrial players, to be able to get access to finance from the concessional layer. At the same, and then finally, the final piece we see in the next few years, in the last few years, is the rising of sustainability-linked bonds, sustainability-linked loans, new kind of instruments for transition finance, which is hopefully would grow in more private sectors finance through the whole discussions. And of course, blended finance are another key discussions. And there's more efforts going on to standardize the approach for blended finance, so that there are more impact, there are more bigger impact, and then also more long-term success for the country itself, for the developing country itself. Yeah.
Excellent. And it's excellent to see that transition where those emerging markets are actually in control of their inputs and their future, and the rest of the world is rallying around to support them in how they decide that they want to do that. That allows me to move to the second part of our panel discussion. And the objective of this session is to dive deeper into the challenges and the practical strategies to mobilize capital for those complex long-term transformational programs inside the emerging markets. So I'm going to we'll change the order up again a little bit. I'm going to go to Joseph next, if I could. Would you mind sharing insights from the recent OECD work on steel decarbonisation in South Africa or Indonesia, for say, on the role of clean hydrogen for us?
Yeah. So indeed, to provide a bit of context, we're working since 2022 with the governments of South Africa and Indonesia in order to identify which policies, regulations, and financial instruments can be implemented in order to support the transition of their steel sector. And I would say, each country has its own challenge, but we have some similarities in both. I think the first one is the infrastructure challenge. And here, very important to have a value chain approach. So typically investing in the power grid is essential to decarbonize the steel sector and to transition towards a hydrogen economy. This is particularly the case in South Africa, that has faced multiple challenges and many hours of load shedding across the country that has prevented the industries from operating at high capacity. A second item to highlight is also to show the local co-benefits and the potential for economic developments. And I'm here echoing what Thuyen described in his previous intervention. We put a huge emphasis on the creation of quality jobs, in particular in South Africa, when building the hydrogen economy, both during the construction phase, but also during operational phase of the country, highlighting as well the trade balance improvement for the country. Both countries are currently exporting a lot of raw materials and minerals, and by developing their industrialization, they can also localize some value added through industrialization. And the last point is also on the development of local solutions, local value chains on both sides. So, for instance, in Indonesia and South Africa, we've been discussing how to make sure that there would be local technology providers and engineering, procurement, construction companies involved in the projects. And on the other side of the market, how to make sure that the domestic market could absorb some of the low emissions goods, and that it would not be only, let's say, building green plants or green steel plants for exports markets. So that is a huge, I would say, a series of items that we have identified at country level. And maybe on the policy side as well, what we see in both countries are that fossil fuel subsidies are still very important in both countries. So also looking at the opportunities to carry out a thorough analysis of these fossil fuel subsidies, how they have been implemented, and to support and to support which country objectives, and see how this could be possibly rechanneled in order to support the green transition without, of course, hindering the support to the local population. And the last point that I would like to highlight is on de-risk and financing. So the key topics for today. Both countries face quite high cost of capital. So we see here, again, the role of de-risking instruments, and in particular, the role of having some support in order to absorb the green premium, which can be partially through exports, but also through contracts for difference, through grants. So also supporting the, I would say, operational costs of these new technologies, not only the investments, but also during the lifetime of the projects.
Excellent. Thank you so much for that, Joseph. For my next question, I'd like to jump to Hian. So the question is, how can international cooperation enhance access to finance for these industrial decarbonisation projects in the developing economies?
Yeah. So in terms of like in the previous round of the discussion, Georgette did mention the role, the big role of international corporations in terms of like promoting, fostering the industrial decarbonization progress in developing countries. And when it comes to actually how we do it, breaking down, bringing the high level global net zero pathway, for example, or the technologies down to the implementation levels in the factories, and helping holding hand with the factories to be in their decarbonization pathway per se. We can see that international cooperation also play a very important role in the sense of bringing the support from donor countries and blended and the technical assistance offer via blended finance facility or via different kind of platform like the global matchmaking platform to support the private sector developing their own transition plan, enhancing their capacity to adopt the technologies and to understand the whole journey of decarbonizations in the factory levels, and also to understand the core benefits of why they need to change and why they should change in the bigger conversations of the bringing more jobs for the country, bringing more opportunities for the long-term success of the projects. In this kind of discussion, we think that the support, the knowledge sharing, and also the capacities of international organizations and EMDEs and IFI to work together with the factories owners, with the industry players to enhance their capacity, their governance, and their strategy to get access to better finance. Is something that I want to highlight in the discussion about the international cooperation role. But then I also want to highlight one important fact is that when we deal with companies in emerging markets, many of them are small and medium sized, and across in different continents, different markets, mediums and smalls are different. So in terms of figuring out the actual interventions to different kind of companies in the value chain, in the context, the local context, we need lots of support and also working hand in hand with partners in the whole value chain, not just of the technology, but also of the technical assistance and financial assistance. And that's essentially the concept of climate GMP, global matchmaking program, and what we are working with OECD to promote. Yeah. So yeah, thank you. Yeah.
Excellent. That highlighting of being fit for purpose and right sized. Braddon, I'll go to you for the next question if I could. And I'm conscious of time. We're getting very close to the end, so we probably only have time for one more question after this. But Braddon, to you, as the chair of the Finance Working Group in AFID, can you give us updates on your group's work and perhaps quite succinctly, if we could, a message of what we can expect from industry?
Yeah. So what we have discussed mostly is the challenges which we face in industrial decarbonization. Especially, we focus a bit more on disproportionate financial support if we consider emerging market and development economies and SMEs. So we discussed what is the barriers of traditional financial model from both sides, from the developer side as well as from the financier's perspective. We also discussed very interesting topic of challenges or understanding on the definition. What is green finance or green project in some countries is not so green in other country. And the one interesting topic is hydrogen, what we hear. And I think if we see multiple countries, there will be various definition of green hydrogen, blue hydrogen, low carbon hydrogen. So we discussed on this definition. We discussed policy barrier, but which more we discuss later is that how we can de-risk this existing and emerging technology, considering all this which I mentioned, whether it is via pilot financing or collaboration, like EU Innovation Fund, for example, or sustainability linked insurance guarantee. What can be the long-term policy certainty? So we discussed that, and we are also going to publish our working group discussion and outcome through a paper or a publication pretty soon in next 3 months or 4 months. I think 3 months. We target to publish it during New York Climate Week, and there we will also summarize all these points.
Excellent. Thank you so much for that. Now, we are getting very close to time, so this is going to be the last question we get time for, and I'll save it up for Tian. How can domestic and global climate capital be mobilised to support not only those emissions reductions that we want, but also achieve goals of economic diversification, resilience, and the generation, of course, of green jobs?
Yeah. So maybe I'll there's 2 points. I think for these hard-to-abate sectors, a lot of the blended finance that need to go ultimately to projects in those countries. The reality is ODA is shrinking. The pool of blended finance at this point, it's either shrinking, it's not going to grow. So I think it's critical to really not spread those scarce resource across many little initiatives. I think really to make courageous decisions on pooling the blended finance toward a fewer number but larger intervention to really move them forward. Because once you have a few projects in a few countries moving forward, it then creates a very good competitive pressure on the next marginal group of countries with better policies. And it's not driven by World Bank or ADB, it's really driven by their private sector players across the value chain wanting to compete with these other countries that have already been advanced and getting scarce blended finance to move forward. So I think the demonstration effect is going to be very powerful. And maybe the last point I'll share is, look, let's remain committed and optimistic even at this time, because when we go across the world and meet with clients on all type of climate solutions, like we say, we don't work in the climate change department. We work for the climate business department, and business goes on, trade goes on, and these solutions are good for business. And that anchors the demand going forward. Thanks, Alan.
Excellent. That sort of echoes, of course, the big message we had out of COP29 that sustainability is good business. Thank you all for those for the questions and your insights. It's now my job as moderator to pass back over to Urban Paker. Urban, would you mind just sharing with everyone just a thanking of our speakers and a quick wrap up for us, please, of our session today? I hope we haven't lost Urban. Oh, he's here. Good.
Yeah, I'm here. Sorry, it took me a while to find the right button. Sorry for that. Well, this has been really a great session, I have to say. It was really a lot of insight, a lot of knowledge. Thanks so much for sharing. And if I need to wrap it up in probably one sentence, I would say that technological innovation is only truly viable when it's matched by innovation and financing mechanisms. And you have shown so many different pathways of how to organize this. We have seen ways to reduce both capital costs and the cost of capital, and it was truly inspiring to see tangible opportunities and pathways laid out for how to de-risk and mobilize capital. And I think it's really important to once again highlight this double dividend of investment in the transformation of the industry as well, and in a truly beneficial investment into the economy. So I really would like to express my sincere thanks to all the speakers. Thanks for your outstanding contributions. And thanks for sharing your knowledge. I think this is something particular in the area of finance. Thanks for your inspiring insights. And to the audience, I hope that today's session has sparked new ideas and will ultimately help to support scaling up and implementing more and larger and more impactful projects across the globe. The path to net zero is complex, and it really demands a coordinated interplay between technology and finance. I think this has been a good webinar in that sense, that we have given some attention to this perspective as well. And collaboration and knowledge sharing, like we've experienced today, will be essential to make this vision a reality. So thank you once again from my side. We look forward to continuing this important journey with you all, and I hope to see you next time in one of our next webinar series. And by that, back to Alan. Thanks.
Thank you, Urban. Some very quick housekeeping. Thank you again on behalf of AFID and Net Zero Industries to all of our speakers, to Mason, to Begonia, to Urban, of course, to Joseph, Ian, Batten, and Toyin. We couldn't do this without you.